Hello, team. In today's video, we're going to show you how to save over $400,000 in your retirement investment account over the next 30 years.
Incredible. Yep. We're so excited.
Wall Street wants you to stay confused. We are overfed with fees.
True.
And over 71% of folks that have a 401k think it's a free lunch.
I know. It's crazy, right? Okay. So Wall Street has tricked you into overpaying for underperformance. And today we're going to fix that. All right. By the end of the video, you're going to know how to increase your investment returns. Okay. Your rate of return, your real rate of return by reducing your taxes and reducing your fees and expenses. Okay. Welcome, everybody. We are John and Tara Thorman. We are Financial Success Coach. Who is coaching you? Because everybody knows that the top performers, the big winners, whether it be sports, business, or investments, all have coaches. And we would love to be that coach for you. So subscribe to the channel and crush that like button so we let everybody know that this is worth watching. Okay?
That's good.
All right. Awesome.
Here we go.
Now, we have been talking about the power of compound interest to grow wealth and to totally change your life. So real quick, these three variables that go into it, right?
Time.
Time is number one variable. The second most important variable.
Money, funds.
Money. You got to have money. You got to start contributing money. And now today we're talking about the third variable, which is rate of return. All right. And this is going to dramatically change your life. So we're going to be talking about taxes and how it affects rate of return, and your fees and expenses and how it affects rate of return. Because frankly, it's all shrouded in black box mystery and nobody knows really what the heck's going on. So we're going to decipher it and try to simplify the whole thing so you know how to respond. Okay?
Once again, they don't want you to know what's going on.
Exactly right. So let's look real first. So I'm going to give you an example. This is dramatic, okay? But it's to drive home the point. So let's take a look at drama. If you had $1 and you doubled it 20 times and there was no tax ever due on that money, you can take a look at this little chart here really quick, and you can see that $1 at the end of year one doubles. Now it's $2. $2 end of year doubles, now $4. All the way after 20 doublings, that single dollar is now worth $1,048,576. Okay, but there's not been taxed at all along the way. So let's look at the same scenario if it was taxed at a 40% tax rate. And that could totally happen depending on your tax bracket between federal and state. You could look at a 40% tax bill. So let's look at that. You would think, just, off the cuff, that if I'm being taxed at 40%, I'll have 60% of the million left over. I should have 600 grand, right? I mean, that's just really kind of a quick, situation. You would think that, right? Well, you would be inaccurate with that assumption, okay? And I'm going to show you, this is how dramatic the taxes play onto your wealth. That single dollar, if we gain $1 in a year and the gain is taxed at 40%, you got to pay 40 cents. So now at the end of the year, you don't have $2 like before, you only have $1.60. And if we repeat that process every year, we tax the gain at 40%. At the end of 20 doublings, we don't have over $1 million anymore. We have $12,000.
Oh.
12,000. Not $1 million, 12,000. Okay. Now I know this is dramatized, okay, not just from me, but also from the numbers. But it's important to understand the impact of taxes on your real rate of return. Remember, we start with the gross rate. And if you didn't see the video the other week, go check it out, because there's a lie out there. It's called the average annual rate of return. And that is what the mutual fund companies and Wall Street promote because it makes the number look bigger than it really is. The real number is the compound annual growth rate. And that can be 2 percentage points less. Okay. And anyway, go look at that video because we explain that in more detail. But the other factor, once you get the gross rate figured out, you got to pull out taxes and you got to pull out fees. And you just saw how dramatic taxes could be to completely decimating the growth of your money over a long period of time. So we have to avoid that, okay? All right, now I want to switch this up. We're going to go from the locker room, folks. We're going to take a little field trip, and we are going to go to Wall Street now because we're talking about taxes and fees. Did you like how I did that? All right, so let's talk about taxes and fees. And to get us started, I think we should take a little clip from the Wolf of Wall Street.
Move the money from your client's pocket into your pocket.
Right. But if you can make a client's money at the same time, it's advantageous to everyone, correct?
No.
No. Okay. The idea, the game is move the money from your client's pocket into your own pocket. That's what we're dealing with here with Wall Street. Okay. So we got to understand how they play this game, because they're siphoning off so much of your money and you have no idea, because you just think, oh, it's a percent here and a percent there. It's not going to make a big of a difference. Oh my gosh, it makes a humongous difference. Yeah. And we have to understand it. Okay. So let's dig into this a little bit more. I got a recent Forbes article here that I want to share with you, which is, for long-term investors, fees really do matter. Now, this is, recent. I mean, it was 2 years ago, I think, roughly, that this article was published. But let's take a look here. What does he say? A financial advisor or wealth manager usually charges around 1% of an investor's assets under management, which seems straightforward enough, right? No big deal. However, depending on the type of investments, many advisors pass on other costs to their clients. These could include investment platform fees, annual fund management fees, other expenses for administration, trading, custody, legal. Pretty soon, 1% advisory fee could increase to 2 or 3% in total. So you've got to be aware of this, okay? But I want you to look at this next, because this is the big one. This is the gotcha right here, okay? And I have highlighted this little thing right here. It says, with hidden costs such as revenue sharing, trading costs, and trailing commissions, mutual fund investors, this is you, right? You probably have mutual funds, and a lot of them, especially if you have a 401k plan. Mutual fund investors could be paying as much as 5 to 6% from their account. Are you freaking kidding me? 5 to 6% of your account can be paid out in fees? This is unbelievable, but it's true. Some fund managers turn their portfolios over more than 100% a year. You can look at that in the prospectus. It'll tell you what the portfolio turnover percentage rate is. And yeah, a lot of times it's well over 100%, which is interesting in itself, right? Because we're told when you go to invest, be a buy, buy and hold, right? The ideal long time frame is forever, right? So you're supposed to hold this stuff forever, but the mutual fund managers are churning like crazy. They're buying and selling all the time, because when they do that, that's triggering trading expenses. So that reduces your rate of return. But often they then get a kickback from the trading company, so it helps them make more money. I mean, it's a little bit insidious. It's kind of crazy, right? Anyways, the problem is many investors are not aware of the fees being charged. Either they weren't fully disclosed, or investors never read or fully understood the disclosure. And 63% of investors either don't think they pay fees, or they don't know how much they're paying. Okay?
So
fees are a big deal.
Then
they don't ask, and they don't tell, and it's kind of a jacked up situation. Yeah. So we've got to dig into these fees, because for every 1 percentage point of fees that you can claw back, that you can recover, it could add over $100,000 a year in income.
Wow.
In your retirement. I mean, this is crazy dramatic, okay? So I have an example here. Let's go back to this Forbes article. It says, consider the hypothetical example. You invest $200,000 over 30 years with an assumed 6.5% annualized return. After 30 years, your investment would grow to the following. Skip down to where it says the yellow, the 1% fee. So 200 grand over 30 years at a 6.5% rate of return grows to $981,678, just shy of $1 million, right? But if you're paying 3% fees, which if you own mutual funds is way likely, like we're probably underestimating it here, okay? Equity mutual funds, to be more specific, you could easily be paying over 3%. But at 3%, the fees are you only end up with $560,000.
Wow.
So right there, folks, that's where we save you over $400,000 with that little trick right there today. Okay. Move from and save 2% in fees over 30 years, and you can save over $400,000.
Wow.
Now, let me ask you this question, okay? Do you consider yourself to be an average investor? Probably, right? I mean, you're not a full-time professional investor, and maybe you've been investing for a little while, so you probably, maybe average, a little bit below, whatever. Check this out. Now, this is really super significant, okay? This is Dalbar. Now, Dalbar has been doing research on mutual funds and investing for over 30 years. And what they do is show you what the rates of return are and contrast that against what the average investor is earning. So let me take our picture off of here so we can focus in on this. Just look at the top half of this graphic, okay? Now, this is for the last 30 years, and it's showing that Dalbar's research, the average equity fund investor versus the indexes over the last 30 years. This is current. This is through the end of 2022, just last year. On the far right, you see the S&P 500. The average annual rate of return, and this is real, this is the compound annual growth rate, okay, is 9.65%. That's over the last 30 years. And that's just the index, right? You can't do that on your own, right? That's just the index, 9.65. So be very suspicious of people who are telling you you can get 10 to 12% return in a good mutual fund, because that's just baloney. Like that does not happen, okay? It's a complete fabrication. It's unicorns and rainbows and crap like that, right? This is S&P 500. The index, 9.65. Now look at the orange bar. The average equity fund investor, so they're not in an asset allocation, they're not a diversified portfolio, it's just an average equity fund investor, not even close, right? 6.81%. Inflation is 2.5%. So what does that mean? Well, if we look now at the bottom, if you had $100,000 30 years ago, and you put that $100,000 30 years ago into the S&P 500 index, okay, let's say you could do that, and you mimicked the market and you got that 9.65%, the balance today would be $1,585,839. Pretty nice, right? But if you're the average investor, you've only got $721,701, maybe. And it could be a lot less depending on the fees that you've got to pay, okay? You're less than half. Like, where did the other $60,000 go, right? So that's why, I mean, it's into the ether, right? I mean, it's into Wall Street is really where it's at, okay? It's not in your pocket, it's in Wall Street's pocket, and they skimmed all that right off the top. So for your compounding to maximize and benefit you the most, you've got to start early, get the most amount of time in, put as much money into it as you can every month, consistently over 30, 40 years or more, right? But you got to make sure that you're not handing that money away in taxes and fees and expenses. Good Lord Almighty. Could you imagine if you've got mutual fund portfolio and you're paying 5% a year in fees? How are you going to get ahead? If the average equity fund is 6.81, okay, you earn 6.81 and you pay out 5%, like you're left with nothing. So that's a disaster, and we want to make sure that that does not happen to you, okay? So that's the Dalbar research. Woo, back to me. That was a little bit long without me. Did you miss me? Okay, I'm back. We're back. Okay, but that's so significant and so dramatic, the impact fees and taxes are going to have on your wealth at retirement. So what you got to do is a review with somebody that knows what they're talking about. So we can help you with that, all right? Get a coach, but don't just get any coach. Get a coach. Get a financial advisor, a fiduciary, right, that can really help you and put your best interest first, okay? That's it for this week. I want to encourage you guys, take a moment and make some changes, okay? This is about behavior, right? This is about transformation, and that means tracking some numbers and making some changes, modifying your behavior, and we're here to help you with that. I'm going to put in the description box below a link so that you can go and check out and get a free retirement plan and see, are you on track or not? And it'll really help you understand where you're at and what you need to do. And I'm also going to put a link in there for a complimentary retirement review. If you want to talk to me as a fiduciary, as a financial advisor, we can do that. I'm not doing that on this channel. This is edutainment, right? Education, entertainment. But my financial planning practice, I am available, and you can talk to me there and get some one-on-one personal financial planning if that's something you want to explore. Okay. But reach out to us. Don't stay in the dark.
Right.
There's things we can do, right? Don't be one of those 71% that think their 401k is free and there's no expenses. Like, that's just crazy, right? Wall Street does not work for free.
Right.
Right? They do not work for free. So be sure to take some action and reach out to us. Let us know how we can help you. But please, again, subscribe to the channel, like the comment, crush that like button, and we'd love to hear from you. Give us a comment down below. Let us know if you learned something new for the first time. Maybe give us an idea on a topic that you'd like us to cover, and we'd be happy to do that as well. Okay? But get a coach. It'll help you perform at your best so you can win your money game. All right. We'll see you next time.